I'm Sean AG, and tonight something quietly huge happened in Europe. One of those moves that looks like a dull policy detail until it starts changing the way the whole board is played. A central bank just signaled that it wants its reserves to behave less like a diversified spreadsheet and more like a shield. Not a little diversification. A posture that says, without saying it, we're planning for a world where trust is thinner, payments can be weaponized, and trade routes get rerouted under pressure. And the ripple effects don't stop at gold. They spill into currencies, supply chains, and a geopolitical chess match that could reprice silver when the world least expects it. Quick favor before we go further. My analytics keep showing that a big chunk of you watch these breakdowns to the end, but you haven't subscribed. If you want me to keep pushing back against recycled copycat takes and keep these deep context videos coming, hit subscribe and drop a quick comment. Type John AG so the algorithm knows this is worth surfacing. And if you want daily updates, quick posts, and my voice notes when something breaks, I've set up a WhatsApp channel and community. The link is in the description. Join it, because some of the most valuable context happens between the headlines, not inside them. Here's the plan tonight. First, I'll walk you through the reserve shock. Why a European central bank is pushing gold toward a concentration level that looks less like a trade and more like bunker strategy. Then I'll connect a second story that looks unrelated, Taiwan risk, silver behavior, and Latin American corridors, but is actually part of the same continuity system. And near the end, I'll give you one watch this first signal that can tell you whether this is a one-off headline or the start of a regime shift. We start with the tape, because the tape is where emotions leak out before narratives catch up. As I'm recording, longer-term yields are a touch softer, the dollar index is drifting lower, and risk assets aren't exactly throwing a party. Gold is pushing higher like it sensed the shift early. Silver is whipsawing, doing that classic move where it tests your patience and your stop loss in the same hour. Energy is waking up too, and that matters, because energy isn't just a commodity. It's a cost structure that bleeds into everything from shipping to manufacturing to the inflation is over story people love to sell. Now the headline that matters. A European central bank, one that has been steadily building bullion exposure, has approved a framework that allows for up to roughly 150 additional tons of gold purchases. If fully executed, that would take total holdings toward the neighborhood of 700 tons. At current prices, that pushes gold toward the high 30s as a share of total reserves, around 37% to 38%, depending on how the rest of the reserve mix is valued. That is not trivia. When a central bank moves that close to a gold-heavy posture, it's not chasing a candle. It's making a statement about what kind of world it believes is forming. And the world they're bracing for looks less like smooth globalization and more like fragmentation. Sanctions, counter-sanctions, blocked payments, rerouted supply chains, and regions trying to insulate themselves from outside pressure. The detail that matters is where this country sits, close enough to real fault lines in European security and trade that tail risk is not an academic word. Central banks watch each other like hawks. They borrow ideas. They imitate what reduces risk. And when a country in a sensitive neighborhood starts turning gold into an anchor, other reserve managers notice, even if they don't say it on camera. I can already hear the objection. Central bank gold buying has been a theme for years. True, but there's a difference between buying and concentrating. It's the difference between owning insurance and building a bunker. A small allocation says, we want a hedge. A rising, high share says, we want a system that still works when the existing system doesn't. Once you see it that way, the next question becomes obvious. What happens to everyone else's reserve strategy when bunker building accelerates? If your neighbor is stacking a settlement asset that doesn't rely on anyone's permission, do you want to be the one holding mostly paper claims that can be frozen, blocked, or politically squeezed? If your citizens are watching currency credibility in real time through prices and wages, do you want to be able to say, we hold what holds up? Here's the market piece most people miss. Big reserve shifts don't just add demand. They change the floor under the price. They turn dips into opportunities for buyers who don't care about your perfect entry. They care about strategic exposure. That means volatility can rise even as the longer-term direction firms up. It's why you can get sessions where gold is up, equities are uneasy, and silver is chaotic. The allocation process isn't clean. It's messy, It's a tug of war between paper positioning, macro narratives, and quiet physical accumulation that doesn't need your approval. Now, the layer mainstream coverage rarely explains. Reserves are about optionality, not returns. Gold is optionality. It can be pledged. It can be swapped. It can be used as collateral when counterparties are nervous. It still works when relationships don't. You don't need conspiracy theories to understand this. You just need incentives. In a fragmented world, the most valuable reserve is the one that functions even when politics breaks the plumbing. That brings us to the twist. The gold story is the headline, but the deeper move is happening in the background of the silver market. Silver is the metal people love to oversimplify. It's not just gold's smaller cousin, and it's not only an industrial commodity. Silver is a strategic input. It sits in electronics, solar, defense systems, sensors, medical applications, and critical infrastructure. When governments plan for resilience, they don't just think about finished products. They think about the entire chain, where the metal is mined, where it's refined, how it's transported, who insures it, who clears the invoice, and what happens if a route or a payment rail gets disrupted. This is where Taiwan enters the frame. Taiwan isn't merely a headline generator. It's a node in advanced manufacturing and semiconductors, and it sits inside the broader question of who writes the rules of trade and security in the next decade. But the world doesn't operate in binaries, peace or conflict. It operates in probabilities and preparation. Even a modest rise in perceived risk changes behavior, because supply chains hate uncertainty. They seek redundancy. Redundancy means new routes, new partners, new processing capacity, and contracts that prioritize delivery over price. That's why you're seeing what I call continuity systems being built. Not plans that look good in a presentation, but systems designed to function when ships are delayed, when routes are disrupted, when payments get blocked, or when political pressure spikes. In that kind of planning, Latin America becomes more important than most people realize, not only because of resources, but because of corridors, ports, rail, energy, processing plants, and logistics networks that decide what moves, when it moves, and what it costs to keep the flow alive. Let's keep it practical. Recognition and votes matter. If a country wants support for a claim, political, territorial, or institutional, it needs partners willing to echo its language in international forums. One way you build that support is by creating economic ties that make alignment profitable, financing packages, infrastructure projects, trade deals, processing capacity, and long-term supply agreements. Those create incentives. So when you see Latin America being courted aggressively, don't only think commodities. Think corridors plus influence. Think who finances, who builds, who controls throughput, who gets the last word when conditions change. Now bring silver back in. When corridors shift and continuity systems harden, the physical flow of strategic inputs changes. When physical flow changes, spreads change, premiums change, and inventory behavior changes. Sometimes the spot price is the last thing to move because the market is adjusting behind the scenes first. That's why watching only a spot chart can leave you blind. If you want to know what's really happening, watch relationships. The difference between where paper sets the reference price and where physical demand is actually pulling metal, paying up, and refusing to wait. Quick side note, because it's relevant to this moment. If you want silver-related success stories, real-world examples of how people stacked intelligently or used metals as part of a broader strategy, there's a separate channel linked in the description. Those case studies hit different than charts. Back to the main thread. Put the two stories together and you get one theme. Sovereigns are repositioning for a world where trust is thinner. That has three consequences. First, gold becomes the reserve anchor again, not because of nostalgia, but because it's functional when the world is fractured. Second, silver becomes more sensitive to shocks because it sits at the intersection of strategic supply and industrial necessity. Third, volatility increases because paper markets are trying to price a world that is becoming less paper-friendly, where settlement and delivery start to matter more than clever positioning. So how do you read silver without getting trapped by noise? Here's the watch this first signal I promised: spread and premium behavior that reflects physical stress. Think about where paper sets the reference price and where physical demand pulls metal. If silver is rising and premiums in key physical markets are rising too, That's a different regime than silver rising while premiums collapse. The first can signal tightness and real pull-through. The second can be more paper-led. Here's a simple way to think about it without getting lost in jargon. If price is rising but the premium you pay for real metal is falling, the move may be driven more by paper flows than by immediate physical tightness. If price is rising and the premium is rising too, that's the market saying, we actually need the material, not just we like the chart. And if price is falling while premiums refuse to break, that can be the most revealing regime of all, because it hints that physical demand is absorbing supply underneath the paper selling. Now loop back to the reserve move, because this is where it all connects. Central bank behavior changes the backdrop for the entire metals complex. It can change how much the world trusts paper claims. It can change how investors interpret drawdowns. If sovereigns are building gold concentration, gold stops being just an asset and starts acting like a policy tool. And when gold behaves like a policy tool, silver, linked by psychology, by metal complex flows, and by hedging behavior, can ride the same waves, but with bigger swings. That's why silver can look sleepy for weeks and then explode in a way that feels unfair if you only watch the spot line. This is the line I want you to remember. Markets don't usually turn on the day the headline prints. They turn when positioning, policy, and psychology line up quietly weeks before. The headline is the permission slip for the move that was already forming. So when you see gold pushing higher while the dollar fades and equities wobble, don't just say gold is strong. Ask what kind of world gold is pricing in. Because gold isn't reacting to one data point. It's reacting to a pattern, heavy deficits, political risk, more fragmentation, and more reasons for institutions to want insurance that doesn't require anyone else's signature. Silver won't behave like gold because it's a hybrid. Half monetary psychology, half industrial reality. On nervous days, silver can drop even as gold rises because it gets lumped into the risk metal bucket. Then it snaps back because factories still need material and shortages don't care about sentiment. Add energy to the picture and it gets sharper because rising energy is a reminder that inflation pressure can come back through the side door even when the main narrative says it's gone. Now, the reserve framework matters not only because of what it buys, but because of what it authorizes. Saying, we can buy up to roughly 150 tons isn't, we will buy it tomorrow. It creates a runway. It tells the market there is permission, machinery, and political will. That changes expectations, and expectations fuel trend extensions. Preparation is contagious. If one country prepares, neighbors start asking, what do they know that we don't? That's when mimicry begins. And mimicry is how slow shifts turn into fast moves. So what could happen next? Keep it simple. If the reserve shift continues quietly, gold can keep grinding higher and silver can lag, then snap, then overshoot, turbulent and unforgiving if you expect a straight line. If a geopolitical headline hits, metals can spike or flush violently and then settle into a new range that tells you the move was a chapter, not the finale. And if policy turns supportive, rate cuts, liquidity, fiscal pushes, hard assets can gain not because of fear, but because of math. Too much money chasing too few things that can't be printed. Now we have to talk about why this story will go viral once people finally connect it. When a country pushes gold toward a high 30% share of reserves, it's not only insulating itself. It's quietly challenging the assumption that the dominant reserve asset stays dominant forever. That doesn't mean any currency disappears tomorrow. It means trust shifts at the margin. And when trust shifts, the pricing of everything shifts. Risk premiums, borrowing costs, exchange rates, and what markets treat as safe. Silver's role in that shift is almost ironic because silver is the metal that gets dismissed until it becomes essential. It's the boring metal that suddenly turns into the critical metal. And markets often move hardest while consensus is still skeptical. When everyone is fully convinced, the move is usually older than people think. So if you see the public distracted while institutions quietly adjust, that can be early, not late. I'm not giving financial advice, but I will give you a practical habit. Pick 3 indicators you track weekly, not hourly. 1. A key gold level and whether it holds. 2. A key silver level and whether it holds. 3. One spread or premium measure that reflects physical stress. If you do that, You stop being surprised by every headline and you start seeing the storyline before it hits mainstream. Now I want this to be a conversation. In the comments, tell me which thread you're watching most closely, the reserve shift, the corridor game, or the silver signal. Then tell me what would change your mind if new information hits. Keep it short so others can scan it. It helps me shape the next breakdown, and it helps the community sharpen thinking together. If you're new here, just say you're here and I'll welcome you. Before we close, one more reminder. The members-only video should be live by the time you see this, and it bundles the latest updates in one place with more context than we can fit here. If you want that deeper dive, the membership link is on the channel. And again, the WhatsApp link is in the description for daily posts, voice notes, and instant alerts. Finally, if you've succeeded in anything lately, metals, business, a new job, a disciplined habit, share one sentence in the comments. It helps more people than you think. Here's the final takeaway I want you to replay. Reserves are becoming fortifications, corridors are becoming chessboards, and silver is becoming a sensor. The price is the headline. The system is the story. Subscribe if you want more of this. Drop your John AG comment, and I'll see you in the next video, because the next move might already be forming while everyone else is still arguing about yesterday. Copyright 2026, John AG. All rights reserved.